Welcome to an in-depth overview of the Reserve Bank of India's Small Finance Banks Concentration Risk Management Directions 2025. In this presentation, we will explore the key guidelines set forth to ensure prudent risk management for small finance banks in India. The core objective of these directions is to manage concentration risk effectively. By limiting the exposure to a single borrower or group of borrowers, the RBI aims to strengthen the overall stability of small finance banks and ensure diversified risk profiles. Voice over script. Chapter 1 introduces the essential terms and the scope of these guidelines. It outlines the short title, commencement date, and the applicability of these directions. Definitions like aggregate sanction credit limit (ASCL) and exposure are crucial for compliance. Chapter 2 emphasizes the role of the Board of Directors in formulating and reviewing policies on exposure limits. The board is responsible for setting sector-specific limits, ensuring diversified exposure across industries, and reviewing intragroup transactions. Chapter 3 sets specific exposure limits for single and group borrowers. A bank's credit and investment exposure to a single borrower cannot exceed 10% of its capital funds, and to a group borrower, 15% of capital funds. These limits help manage risk effectively. Chapter 4 specifies that banks must maintain a diverse loan portfolio. At least 50% of a bank's loan portfolio should consist of loans of 25 lakh rupees or less. This ensures that smaller, less risky loans form a significant portion of the bank's lending. Chapter 5 establishes prudential limits for intragroup transactions. Exposures between related entities should be controlled to avoid excessive concentration within the group, with specific caps on single and aggregate intra-group exposures. Chapter 6 addresses managing exposures to foreign countries. Banks must set country exposure limits, ensuring that risks from international markets are monitored and controlled, thereby minimizing global economic risks. Chapter 7 outlines the regulatory framework for interbank liabilities. Banks need to adhere to exposure limits for transactions with other banks, ensuring that no bank becomes overexposed to another in the financial system. Chapter 8 addresses the repeal of prior guidelines and provides for the continued application of existing laws. It ensures a seamless transition to the new directions without disrupting financial institutions' operations. The Annex I lists institutions exempted from the capital market exposure ceilings. These include notable institutions like IFCI Limited, SIDBI, and EXIM Bank, which are integral to the nation's financial infrastructure. To conclude, the Small Finance Banks Concentration Risk Management Directions 2025 introduce vital frameworks for managing risk and ensuring financial stability. Banks must adhere to these guidelines, diversify their portfolios, and maintain strict limits on exposures to ensure a resilient financial ecosystem. Munses and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations, then fintech, expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA, comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring-fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.